Hello, everyone. Welcome back to another in my series of short videos, at least short for me, knowing that I'm not known for brevity. So welcome. Thanks for coming. I do appreciate your time. Let's see, if you like what you see, you want to give a thumbs up on YouTube, that would be great. If not, no problem. As always, if you have questions, comments, or you want to push back on what I'm saying, please feel free to pick up the phone. You can old-fashioned, you can call the office, and I'm happy to have a conversation. We can Zoom. You can send me an email. So it's all good. If you agree, don't agree, this is all. I don't have. I didn't corner the market on certainly knowledge. Every day is a learning experience. So tonight's short video is going to be a follow-up from the last one I did on recession. That generated an awful lot of questions, comments, and I love the pushback. No, you're way wrong. I'm way off base. The U.S. economy is already in recession. I told you this already. I still respectfully disagree. And when we came into the year, I did not rate recession as a high probability for 2022. And remember, as I said in the last video, recession is not back-to-back quarters of negative GDP growth, as the textbooks may have you believe, or the media. Recession is only declared by the NBER, National Bureau of Economic Research. They're the arbiter. You don't have to agree with that. That's just how it's been. They're a nonpartisan organization. So for some people who say, well, they're Republican, they're Democrat, they're nonpartisan. So the recession or a recession isn't fully declared until the NBER says so. We had a negative quarter of GDP growth in Q1. My guess is Q2 is probably around the zero line. Could be up a little bit, could be down a little bit. I don't think it's going to be great. I don't think it's going to be horrific. But I want to follow up and do two things. One, let me share my screen and let's do this the right way. So we're talking here, this is from the St. Louis Fed and the Fred database. So I said last time, or I think maybe I wrote in a blog, doesn't matter, that when the jobs numbers, the monthly jobs numbers that come out the first Friday of the month, we just saw 74,000 new jobs created in the month of June. It is almost impossible to have the US in recession with 370,000 new jobs. In any other environment, that number is a rah-rah, we clap, way to go. So it's really hard to believe the US is in recession when we've just created almost 375,000 new jobs. You don't have recession like that. Unemployment rate is still, scraping along at 50-year lows at 3.6%. So what you're looking at right in front of you is the unemployment rate in blue. And you see how it fluctuates up and down, mostly with recession. And you'll see in light gray all of the recessions. So the takeaway, folks, is that the recession isn't declared in hindsight until the unemployment rate has curled higher and begins heading higher. So you'll see in, where are we? So this is through March, April, June of 2022. So it's up to date. And you'll see the 08 recession didn't come until unemployment had hit 5, and in 01 the recession was, unemployment was 4.4. You get my drift. Back here it was 5. We're scraping along at 50-year lows. Now, yes, unemployment may be the most lagging indicator of all. That may be the absolute tipping point, but we're creating jobs and unemployment is still super low. I think we are going to see a bottom in unemployment right now in the summer. And I think it's going to curl up and begin to go up rest of the year, early next year. But to say we're in recession now doesn't hold water if you look at the jobs numbers. Let me share two other quick tidbits that I'm going to share on the blog. And these are two kind of, off the beaten path esoteric indicators. My architect loves when I show this one. This is the Architectural Billings Index, National ABI. And this is non-residential projects by architects in this survey that goes back a long time. But the 50 line is when you know, Houston, you have a problem. When the number curls below 50, it says we've got some economic problems. This is not in a vacuum by itself, a sell signal that a recession is here, but it's pretty good. And while it's curled down from the upper 50s, it's still above 50. So this is the architects in the non-residential space are saying that business has softened, but it's not in recessionary levels yet. So another thing that we need to get through some more time before this can give us the indication. And finally, let us go to this is the Restaurant Performance Index, which I like because it's more of a measure of the consumer and it tells you what's going on at the restaurant level. The 100 is the basically neutral level. Above 100, economy is expanding. Below 100, economy is contracting. We know during COVID that the economy and the restaurants got closed. It's really unfair. This is an unfair period because restaurants collapsed because they were closed. And then when they were reopened again, everybody and their mom, grandmother, aunts, uncles, and cousins went out and dined out. So these two numbers, down to 95 and up to 106, not exactly apples to apples historically, but we can see right now that the number is still a little above 102. Again, that's still signs of an economic expansion. It's going to, even if recession is around the corner, it's going to take time to wear these numbers off. Architects, restaurants, two very different parts of the economy, and then the jobs numbers. So you got three there that tell you recession's not here yet. It may be coming, but it's not here yet. And you can throw tomatoes at me. Maybe it comes end of the year, Q4 at the earliest. Maybe it's Q1 of next year. Maybe it doesn't come at all. Because remember, I put my stake in the ground and I said, if there is no recession, the Dow's going to 40,000 next year. People are like, Shaz, have you lost your mind? Are you on drugs? Are you drunk? Are you cognitively impaired? No, if you don't have recession with all those rate hikes and inflation, look at 1995 as your model and markets should scream higher 30+%. But let's put in the cart so far in front of the horse where it's July 17th. Let's not worry about 2023. Let's focus on 2022, figure out what's in front of us. I'll close with this. I keep doing this with clients. I keep saying, we need this. This is time. The market made a low June 17. We don't yet know if it's the low. I don't suspect it is, but I'm not going to pound the table right now. We need time. Too many of the stocks and sectors that got pounded need time to repair. Without the Fed coming to the rescue, a la 2018, March 2020, where we saw V bottoms, we are going to see a bottom that goes like this, like an alligator's mouth. And that's what we're experiencing now. We need to get another, I don't know, July, August, September, 4-ish months plus hence. We need to get forward. So lots of this before I'm going to make another big claim. But for now, the market's trading constructively. It's not bowling me over from the bullish side. We don't have these huge bouts of buying interest, but selling has certainly dried up for now. And with that, I say thank you. Let's get out of. I should have stopped sharing it earlier, but I'm sure you'd rather look at the chart of the Restaurant Performance Index than an unshaven, unshowered me on a Sunday afternoon. So again, I thank you very much for watching. Please let me know questions, comments, want to push back. Please give me a thumbs up on YouTube if you enjoyed the video. And I'll be back during the week with lots of updates. Thank you. Bye-bye.